In the given question, we are given the data for Ford Motor Stock, which has an expected return of 20% and a volatility of 40%, and Molson Coors Brewing, which has an expected return of 10% and a volatility of 30%. And if the two stocks are uncorrelated, we need to find out the expected return and volatility of an equally weighted portfolio of the two stocks. And in part B, we need to find out whether investing all of your money in Molson Coors stock an efficient portfolio of these two stocks. And in part C, we need to find out, is investing all of your money in Ford Motor an efficient portfolio of these two stocks. Now coming to the solution. Part A. If the portfolio is to be constituted having weights of 50% investment in Ford and 50% investment in Molson, the expected return on volatility will be calculated as below. Expected return of the portfolio will be 20% multiplied by 50% plus 10% multiplied by 50%. It will come out to 15%. Now finding out the volatility of the portfolio, putting the figures in the formula, we'll get the volatility of the portfolio as 25%. Now coming to next. If 100% money is invested in Molson Cars, the return would be 10%, and this return is lower than the return of the portfolio as constructed in point A above, which is 15%. So it is not advisable to invest 100% money in Molson Cars. Now coming to part C, if 100% money is invested in Ford Cars, the return would be 20%, which is higher than the expected return of the portfolio, which is 15%. Now we need to find out the coefficient of variation that needs to be found out so that we can compare between the Ford and the constructed portfolio. Now the coefficient of Ford is 40% divided by 20%, that is 2. And the portfolio coefficient is 1.67. Since the coefficient of portfolio is lower, it would be more efficient to make investment in the portfolio as constructed in point A above. As the coefficient of variation is lower, the better.